Hi everyone, welcome to another video in our option selling strategies series. So we have covered short straddle, positional strategy, and we have covered the adjustments for short straddle positional trade in Indian index markets. So today's topic is what adjustments can be done for short strangle positional trade in Indian index markets, and we will go through various scenarios and examples related to Nifty, Sensex, and Bank Nifty, and what and each adjustment that could be done. Okay, so before that, what is a short strangle? A short strangle is when you sell an OTM call, out of the money call, and out of the money put, and it's not an ATM call or put. When you sell an ATM call or put, it becomes a short straddle. But when you sell an out of the money call or and an out of the money put, then it becomes a short strangle. And when you do this, when you expect the market to be range bound and time decay, when you are expecting, that is when you do a short strangle. Okay, example of that is, for example, Nifty spot is 22,000, then you will sell 22,400 CE and 21,600 P. So what is your view is that market will stay below 22,400 and it will be above 21,600, 400 points. Um, you have taken the width that the market will be within 800 points. Okay, 400 points above the spot, and as well as 400 points below the spot. So total premium corrected. This is example. So 60 for suppose for C and 70 for PE. So that's 130 rupees. So max profit is 130. You will gain if market stays within that 21,600 and 22,400 till expiry. And that could be a weekly expiry or a monthly expiry. If it's a bank nifty, it would be monthly expiry. If it's a nifty and sensex, it would be a weekly expiry as well as a monthly expiry. Generally, positional trades are taken on a monthly expiry. Okay, so that's what it is because you get larger width and okay. So but short strangle is it's not a hedged strategy, so loss is unlimited here, and once the market moves beyond your break even, then loss could be unlimited. You'll get some break even based on the position you have taken. For example, in this it's given like 24,470 on the downside is a break even, and 22,530 on upside is a break even. Okay, so why are we doing adjustments? We are doing adjustments to protect capital and reduce directional risk and increase theta decay and avoid gamma explosion. So those are the reasons why we do adjustments basically. So when what are all the scenarios for short strangle when we need to do adjustments, and what are the different examples? We will go through that. So first is market trending on one side. So it's a directional movement is there within the market. So your view was that market will stay within a 400 point, 800 point range from 22,000. Okay, but market. The real market went one sided in a directional move it has given. For suppose in this scenario it moved from 22,000 to 22,450. We have taken a position of 22,400 C, right, that it will stay below 22,400, so that leg will start bleeding and it will be in loss. Okay, so what adjustment we need to do is we need to roll that tested leg. So basically we buy back that 22,400 CE and we buy a 22,600 CE, which is above. And we basically shift that call, that OTM, basically. And the other thing you could do is, we bought a 21,600 P. We could keep it as it is, or we could roll that also, the untested P also, from 21,600 to 21,800. That is the adjustment. So what we are doing is, when market is directional and it has towards one side, we are rolling that tested leg and shifting it to an the call, whatever test is whatever leg is tested, we're shifting that to for OTM, and we are optionally we can also roll the untested PE also. Example here is 22,400 CE, 60 rupees. If it was and it went to 150, you got a loss of 90 rupees, and we bought 22,400 CE. We will buy that because it's in loss, and then we'll sell 22,600 CE for 60 rupees. Okay, and move PE from 21,600, which is 70 rupees. You'll gain profit there, and you will move that to 21,800 or 40 to regain theta. So that's the first adjustment. So when a market is directional, we will roll the tested leg and shift the OTM on that tested leg side, and we will also roll the untested leg also. Next one is breakout with high momentum, stop loss is hit. So scenario is Bank Nifty breaks 49,500 strongly. Okay, so this is, that one leg, whatever range you had, one of the legs range is hit, but it's hit with high momentum in this case. Okay, so for suppose the 49,800C in this case, which you shorted, has hit hard. Okay, so the adjustments that you could do are, you convert this strangle into a straddle, but you convert this, you put this straddle the new ATM where the market is basically. So you shift that, you took a for OTM or C and P, right? And the market went in one direction. For suppose, let's assume that it went to 49,800C in this case, and or 49, yeah, 49,800C, it has broken. Let's assume it went to 49,900, so it has broken your C leg. Then what you do is you remove these both legs that are there at 48, 49,800, whatever legs you have taken out of money legs, like 49,800C you have taken, and probably you could have taken, so 400, right? So the spot would have been at 200. So yeah, 5200 is the spot, and 5600 could be the other side P you would have taken. So what you'll do is you will now convert that entire strangle into an ATM. So whatever leg has been hit, you will take that as the new ATM, and you'll convert it into a straddle, and you'll buy a 49,800C and P it with that. Or you could do another adjustment. You would convert this into an inverted strangle and sell both legs on the same side, because P is giving profit and C is hit with the stop loss. You remove that stop loss leg, and you add 49,800 P and 5,100 P. So you will sell on the same side. You will sell basically. You will take a directional view in this particular case from a. So you'll convert your non-directional range bound view to a directional view here. Okay, you could do that, or you could again be non-directional and shift that, the center to where whichever leg has been broken. Example is BNF spot is 49,900, your call side is busted, so 49,800 CA is busted. You would invert the position, so you can sell 5,100 P or 5,400 P, or you could sell 49,800 P and 5,100 P. So you're taking a directional view. Since it broke your call, it's you're assuming that the market is bullish and it will be bullish, and you're doubling down on that view. Or you could expect a mean reversion and a slower move, and you can take a straddle also with the new 49,800 C and P. Okay, then there's a theta decay without movement. This is the ideal scenario. This is what we have expected, and when market stays within that range, okay, so so market stays within 21,900 and 22,100. You sold 22,400 and 21,600. So that's exactly what you expected, and that's what has happened. So you don't do anything here. You just uh, whenever the market expiry is near, you roll down those legs closer to the spot to increase the premium basically. You took for OTM, right? It's like 22 400 and 21 600 you have taken. You could book the profit, and you could, because the market is range bound, you could reduce the you could move closer to the spot, like you could take sell 22 200 and 21 800. That will improve your premium. It will give you higher theta decay. It will keep the zone dynamic if the market stays range bound. Spike in implied volatility. So there is an event risk, like example budget, RBI, global news, VIX spikes in this case. So for that, to protect yourself against it, you buy cheap OTMC and P to protect tail risk. And once you add this cheap OTMC and P to protect yourself, it will convert into an iron counter. Okay. So example is 22,400C and 21,600 P. You have shorted. That's a short strangle. You will buy 22,700C and 21,300 P of 10 to 15 rupees each, and risk is capped and margin is reduced. It becomes an iron condor, and it's a hedged position. Then risk is um, defined in that particular case. Volatility crush post event, premium collapse after RBI announcement or market comms scenario, or options lose value rapidly. So what you do is you exit the position partially, you lock the profit. Okay, whatever profit you have got, you lock it, and you roll out to the next week so that you get a wider range. That's what you do. So you exit the current strangle and to take the profit and enter a new strangle with for the next week, so that you get a wider range and continue theta harvesting. Okay. Market gaps overnight, gap risk if it is there, like overnight US crash or Nifty opens gap down at 21,400, then whatever, because PE will, if it's gap down, PE will lose, you'll buy back that PE and you'll sell a new for OTM PE and hedge the call side with small lot for protection. You'll just hedge, put a hedge on the call side also with a small lot for protection. Okay, so initially 21,600 P you have taken. Suddenly gap down has happened and you got 70 rupees became 250, so it's a loss. So you'll buy back that particular 21,600 P and you'll sell another 21,200 P. Okay, optionally you can sell 22,000 C also to recover. Okay, because C will make money in that case, so you could do that also. Then we have sloped strangle, directional view based adjustment. So this is a directional strangle. So if you're mildly bullish and on Nifty or mildly bearish on Nifty, then what you could do is you would put a bullish or a bearish strangle also. You could do instead of a range bound 400 points. What you could do is you could shift whatever view you had, like mildly bullish view you have, then you shift put like a closer and leave CE further. Okay, so because you are of the opinion that it is bullish, right? So you can take a very nearer put, but C you can take further. Okay, like you sell 21,800 P and 22,600 C. Similar you could do for bearish also. So in the case of bearish, you will shift C leg closer and leave P further. Okay, this way it's a directional strangle, and that is a directional adjustment you do. You'll collect more premium because of this, and you will leave room on upside. On the upside you will have more width. Okay, so adjustment summary table, trending market, you roll the tested leg. Okay, breakout you convert to straddle or inverted strangle. Range bound you shift the strike, it strikes closer. High volatility you add wings and becomes an iron condor. Low volatility you roll forward to the next expiry. Gap opening you adjust directionally. Okay, and directional view you take a skewed strangle, a directional strangle. Okay, and you can use some tools like Obstra to for adjustment and monitoring, sensible trading view. Okay, Quants app. Yeah, some tips are, adjust when one leg doubles in premium or delta is greater than zero point 0.3, you do an adjustment when delta is greater than zero point 0.3. Monitor IV correction spikes closely. Keep a stop loss, max loss per trade and respect it. Use hedges or wings in high wicks or during event weeks. Don't widen range too much for higher premium, reduces the risk reward. Okay, so these are the adjustments that could be done on short strangle, guys. So that's it for today. Thanks everyone, have a nice day, bye.